Imagine this. A company, right? No sales, no actual products out there, a history of losing money. Yet, somehow, it hits a multi-billion-dollar valuation. And then on just one day, the stock price jumps over 120%. I mean, how does that even happen in a market that's, supposed to care about fundamentals? And maybe more importantly, what does it tell us about where value, real value, might lie in today's markets? Today, we're diving deep into the, fascinating and frankly pretty baffling case of Regencell Bioscience Holdings Limited. That's RGC. And we're looking specifically at the situation around July 3, 2025. Our mission today really is to unpack this whole mystery, explore what actually fueled that incredible rise, and figure out what it means for you, the learner, as you navigate your own financial journey. Now, we've heard some talk, claims even, of a short squeeze happening with RGC, but our sources, they tell a very different story, a much more intriguing one, actually.
Yeah, what's really fascinating here is that the evidence, well, it strongly suggests this wasn't your classic short squeeze scenario at all. Instead, it looks like it was this potent mix of factors. You had an extremely low public stock float, a very recent forward stock split, and honestly, a really compelling narrative. Speculative, yes, but compelling enough to grab a certain kind of market attention.
Okay, right. So let's unpack all of that. Let's try and get to the bottom of how a company with, such a unique story ended up with this curious, almost gravity-defying valuation. To really get a handle on RGC, we need to start at the beginning, the foundation. Understand what this company actually does, or at least what it aims to do, and how it plans to make money eventually. So we're starting our deep dive with part one, the business, management, and money. And let's kick things off with chapter one, business analysis.
Okay, so Regencell Bioscience. It's an early-stage, pre-commercial bioscience company. They're based in Hong Kong, but incorporated in the Cayman Islands. Their entire business model, like the whole thing, is focused on research, development, and eventually commercializing these proprietary therapeutic formulations that come from traditional Chinese medicine, or TCM. But here's the crucial part, and you really need to grasp this. As of July 3, 2025, the company has exactly zero revenue. Zip nada. It's basically like a venture capital bet, a bet on a scientific idea, funded entirely by investors' money, mostly from their IPO, back in July 2021.
Zero revenue. Okay, that really throws that valuation into sharp relief, doesn't it? So what exactly are they trying to sell or planning to sell? What are these products supposed to be that justify this kind of market cap?
Right, so their main focus is on three specific TCM formulae. They're liquid-based, standardized candidates designed to treat different levels, mild, moderate, severe of ADHD, attention deficit hyperactivity disorder, and autism spectrum disorder, ASD. The whole idea is to offer a natural, kind of holistic alternative to conventional treatments. They also have a secondary thing going on, a joint venture with a company called Honor Epic Enterprises. The plan there is to offer TCM-based COVID-19 treatments in places like ASEAN countries, India, Japan, Australia, and New Zealand.
Okay, so they're definitely aiming at some big health problems, significant issues. But what about the company itself? Like operationally, how big are they?
Oh, operationally. Tiny. Minuscule, really. As of July 2025, they only had 12 employees. 12. They're very much a niche player trying to apply these TCM principles to really complex neurocognitive disorders. Their whole operating history going back to 2015, it's just been R&D, research and development, no commercial sales at all.
And their unique selling point, their sort of big bet, the thing that makes them different.
Well, their value proposition is basically offering these natural, holistic treatments for ADHD and ASD. Now, it's important to note this isn't based on widely accepted large-scale scientific proof. It's more based on the anecdotal success and the clinical experience of one specific TCM practitioner, Mr. Sikio. And he happens to be the father of the company's founder and CEO.
Okay. That's a very specific niche. What about the wider market? Is TCM itself a big deal? And who are they actually competing against in this space?
Yeah, the global TCM market is actually pretty substantial. It was valued at around $28.7 billion back in 2022. And projections show it growing to nearly $50 billion by 2033. That's about a 5% compound annual growth rate. And there is some, preliminary scientific interest in using TCM for ADHD. Some small studies suggest certain compounds might help. But, and this is a big but, that research is really in its infancy. It lacks those big, rigorous clinical trials. As for competition, it's fierce. They're up against, first, the established pharmaceutical giants, the ones dominating the ADHD market with FDA-approved drugs like Adderall, Ritalin. These guys have massive R&D budgets, huge distribution networks, and then they also compete with a whole scattered landscape of other alternative medicine providers, some publicly traded ones like China XXT Pharmaceuticals, plus countless private TCM practitioners.
Wow. Okay, that sounds like navigating my minefield, especially with the regulatory side of things. What does that path look like? Getting a TCM product approved, say, in the U.S.
Yeah, that. That is probably the single biggest hurdle they face. In the U.S., TCM products, they often get regulated as dietary supplements. And supplements, well, they can't legally claim to treat specific diseases like ADHD or ASD. So for RGC to actually market their products as a treatment, they'd have to go through the FDA's really tough new drug application process, specifically for botanical drugs. That process is incredibly expensive, takes years, needs extensive trials, and historically, only 2 botanical drugs have ever actually gotten FDA approval, ever. Their first goal seems to be getting approval in Hong Kong, which, has its own process.
So incredibly high barriers to entry, definitely. What about their actual competitive edge then? Do they have one realistically in this tough environment?
Well, from a sort of standard business point of view, RGC currently has almost no durable competitive advantages. None. No brand recognition, no cost advantages, certainly no network effects. Their only unique asset, really, is the intellectual property connected to those proprietary TCM formulae from the CEO's father. And the actual value of that IP,
Yeah.
it's entirely speculative right now and hasn't been proven by independent scientific research.
Okay, that paints a pretty stark picture. A company facing huge challenges built on a foundation that's, well, highly speculative. Which immediately makes me think about the leadership. Who's steering this ship? So let's turn our attention now to Chapter 2, Management Evaluation. Who is actually running Regencell Bioscience, and what can their actions tell us about this whole situation?
Right, the leadership really centers around the founder, chairman, and CEO, Mr. Yat-Kyo. Now, his background, it's in finance, investment banking experience, not science, not medicine. What's interesting, though, is his deep personal connection. He states publicly that he has ADHD-ASD himself, and that he was the first patient to actually benefit from his father's TCM treatment. And he's put his money where his mouth is, so to speak. He's personally invested over $9 million in RGC.
A CEO with the finance background, but also a very personal stake. That sounds, well, it sounds compelling, right? Aligning his interests with shareholders. But how have they handled the really big challenges, like these insane stock swings and all the scrutiny that comes with that?
Well, the company's main crisis, if you want to call it that, has been this extreme stock volatility. Management's public line was that it was due to a short squeeze. But, like we mentioned earlier, the actual market data doesn't really back that up. S3 Partners, they're a data analytics firm, they specifically noted that, quote, long buying and long selling was by far the primary driver, unquote. So this raises some pretty significant governance questions, Is management being fully transparent about what's driving the stock? Or are they maybe cultivating a specific narrative to appeal more to speculative traders?
Right. So his investment banking background was obviously key in getting this small speculative company onto NASDAQ. Crucial, probably. But the core risk here isn't financial engineering, it's scientific validation. Does this create an imbalance?
It potentially does. I mean, he clearly has the skills to package a narrative, navigate capital markets, essential for the IPO, no doubt. However, the scientific leadership seems to primarily rest with his father, the TCM practitioner, and maybe one other director. So you have this potential imbalance, yeah? The skills that arguably generated this huge valuation might not be the same skills needed for the long, hard slog of drug approval and commercialization. That's a definite long-term risk.
And how is a company like this, pre-revenue, actually using its money? What's their capital allocation strategy look like?
Well, for any early-stage company, capital allocation is high risk by nature. The cash they got from the IPO, about $19.3 million net, was specifically earmarked for the core R&D, paying staff, and registering their intellectual property. It's pure venture capital style investing. You won't see any M&A strategy, no share buybacks, certainly no dividends. It's all expected, though. They need to conserve every penny of cash.
And what about traditional financial metrics? Like, how are they actually performing? I guess profitability isn't really part of the conversation yet.
No, not at all. Return on invested capital, for example, is deeply negative. It's not even a meaningful metric at this stage. They have zero revenue. For their fiscal year 2023, they reported a net loss of just over $6 million. So the really relevant metrics for anyone watching this are their cash balance, which was about $7.96 million as of June 2024, and their cash burn rate. How quickly are they spending that cash? That rate was about $1.21 million per quarter. So their financial runway, how long that cash will last, that's absolutely critical to monitor.
Okay. So understanding the business model, or lack thereof, and the leadership, now it's time to really face the numbers head on. Let's dig into Chapter 3, financial analysis. And just a heads up, you might have seen some truly wild numbers thrown around about Regencell online, but we need to set the record straight immediately here.
Yes, this is absolutely critical. A lot of third-party financial data platforms, the ones people check online, they report completely false financial data for RGC, like showing trailing 12-month revenues over $3 billion. This is demonstrably false, just plain wrong. The company's own official SEC filings state very clearly that it's a pre-revenue entity. Consistent operating losses, like that $6 million loss in fiscal 2023. The error probably comes from some automated system confusing RGC with a different ticker, maybe RGCO, which is a utility company. So just to be clear, our analysis relies exclusively on the official SEC filings. Zero revenue, ongoing losses.
Okay, thank you for clearing that up. That's crucial context. So if we ignore those bogus figures, what does the real financial picture look like?
Well, their market cap, as of July 3rd, 2025, it swings wildly, between maybe $5.1 billion and $8.4 billion because of this extreme volatility. That is just an extraordinary valuation for a company with no revenue and very minimal tangible assets. Revenue growth doesn't apply. Counter margins. Mathematically, they're undefined, or you could say effectively zero, given the consistent losses, free cash flow. Consistently, significantly negative. They are burning cash to fund that R&D using the IPO money.
Okay, burning cash, yes. But are they about to, run out tomorrow? What's their immediate liquidity situation?
Actually, their short-term liquidity looks quite strong on paper. They had that $7.96 million in cash and short-term investments and only about $220,000 in total liabilities. So their current ratio is exceptionally high. They aren't loaded up with debt. Everything's owned by equity. But, and it's a big but, earnings are consistently negative. So that cash pile will run down eventually unless they raise more capital or, miracle of miracles, start generating revenue.
Right, and this is where it gets really, really perplexing. How on earth do you even begin to put a value on a company like this? The standard tools must just break.
They absolutely do. Your standard valuation methods, the ones that rely on earnings or sales, they just don't apply here. Price to earnings ratio, meaningless with negative earnings.
Yeah.
But the price to book ratio, the PB ratio, that is incredibly revealing. If you take a conservative market cap, say $5.12 billion, and their total equity, which is about $8.2 million, their PB ratio is an astronomical 622 times. Some sources even put it over 1,000 times. Just to give you some perspective, established, profitable pharma companies, they might trade at maybe 3 to 8 times book value.
Yeah.
So RGC isn't just high, it's in a different universe. It completely defies rational comparison. It signals a valuation totally, utterly untethered from any tangible asset value. It's like valuing a kid's lemonade stand at the price of Coca-Cola.
Wow. That comparison really hits home. Mind-boggling. Okay, what about the sort of gold standard, the discounted cash flow model? Can we even attempt that here? Does it give us any clarity, despite all the huge uncertainties?
Honestly, applying a DCF model to RGC isn't really a valuation exercise in the normal sense. It's more like a highly speculative intellectual exercise. Pure guesswork, really. The final number you get is entirely dictated by assumptions that are just hugely uncertain. What's the probability of actually getting regulatory approval? What's their future market share going to be? What discount rate do you even use to reflect this extreme level of risk? But okay, let's try. Even if you make some highly optimistic assumptions, say a 10% chance of success, maybe $500 million in peak annual sales 10 years down the road, healthy profit margins, even then, an educational DCF model would likely spit out an intrinsic value per share somewhere between maybe 50 cents and $5. You roll a 50 cents to $5, which just dramatically highlights how completely detached the current market price is from any semblance of fundamental value.
So the numbers just scream disconnect, don't they? What's the core message we should take away from this financial deep dive?
I think if you connect all these financial dots back to the bigger picture, it strongly suggests the current market price isn't really about the company's financial performance or prospects, not in any traditional sense. It's about something else entirely. It's a valuation driven by forces way beyond standard financial analysis.
That financial picture is stark, isn't it? A clear, massive disconnect from any traditional idea of value. So, if it's not the fundamentals driving this stock, what is it? Let's dive deeper into part 2. The market, ownership, risk, and conclusion. We're starting this section with chapter 4, market sentiment. This is where we really shift gears from the hard numbers to, well, market psychology.
Exactly. Market sentiment appears to be the primary driver for RGC. And it's sharply divided, bifurcated, one really glaring indicator, the complete lack of research coverage from professional sell-side analysts at the major investment banks. For a company supposedly worth billions, this is highly unusual. It's a powerful bearish signal. It basically implies that the professional investment community, the ones who rely on fundamental analysis, they consider the stock untouchable. The science is too speculative, the financials are too thin, the valuation is just indefensible. Morningstar also gives the company no economic moat, meaning they see no sustainable competitive advantage.
Okay, so the traditional analysts are staying away. What about the general media? What's the tone there? Positive, negative? Just confused.
Oh, the general media tone is overwhelmingly skeptical. Cautionary even. You see headlines with phrases like speculative frenzy suggests Regencell Bioscience, RGC, is a house of cards. The news flow isn't really driven by any fundamental developments at the company because there aren't many. It's driven by market events. The wild volatility, the frequent trading halts on NASDAQ, that recent big 38-for-1 stock split. The narrative being pushed is that this rally is all about a compelling story, not tangible results.
And what about those market indicators people often point to, like short interest? What do they tell us about sentiment, especially considering the company's own short squeeze claims?
Yeah, despite what the company might say, a short squeeze just doesn't seem to be the main driver here. Short interest is actually relatively low, somewhere around 3% to 3.5% of the public float. S3 Partners, again, they noted it was long buying and selling driving the action. There simply isn't enough short interest to fuel these kinds of massive price jumps. It looks much more like enthusiastic buying, maybe FOMO buying, not panic shorts covering their positions.
And if you look at the charts, the technical picture, what's that telling us about how this stock behaves?
Well, the price action is just incredibly erratic when you compare it to its key moving averages. Like on July 1st, 2025, it dropped below its 50-day moving average. Then, the very next session, it soared almost 140% above it. That kind of extreme deviation, it signals a complete lack of stable, predictable trends. It's basically the technical signature of a stock being driven by news hits, by emotion, by speculative momentum, not by long-term, fundamentally driven investors.
Wow. It really underscores how powerful emotion can be over fundamentals in certain parts of the market, doesn't it? That makes perfect sense. Clearly, emotion is overshadowing the fundamentals here. And if the sentiment is that speculative, then who owns the stock must be a huge factor too. Which brings us neatly to Chapter 5, ownership structure. This might actually be the most critical technical piece explaining that extreme volatility we've been talking about.
Absolutely. Institutional ownership in Regencell, it's practically non-existent. Fintel data shows only about 7 institutional owners holding a tiny, trivial number of shares, like 15,000 shares. That represents 0.00% of the total shares outstanding. And those few institutions, they're mostly passive index funds or maybe some quantitative trading firms. They aren't active, fundamental asset managers making a deliberate bet on the company. So the professional investment community has, for all intents and purposes, completely avoided this stock.
Okay, so the big money, the sophisticated players, they're staying well clear. What about insiders then? The people closest to the company, how concentrated is the ownership there?
That's where it gets really interesting. Ownership is overwhelmingly concentrated in the hands of the founder and CEO, Mr. Yat Gayua. He beneficially owns somewhere between 81% and 86% of the entire company. You combine that with other insiders, and the total insider ownership is roughly 93.8%. Now, this qualifies RGC as a controlled company under NASDAQ rules, which means it's exempt from certain key corporate governance requirements, like having a majority of independent directors. It basically gives Mr. Ayer absolute control.
Right. Okay, that's key. Immense concentration means an incredibly small public float, the shares actually available for trading. What does that mean for volatility and for anyone trying to actually trade the stock?
Exactly. That immense concentration means the public float is tiny. Estimated at only about 30.5 million shares out of a total of nearly 495 million shares outstanding. This creates that classic low float situation, where even a modest amount of buying pressure can cause outsized price swings. It makes a stock incredibly sensitive, ideal for speculative traders, and highly susceptible to dramatic moves on very low trading volume. It really raises questions, doesn't it, about the influence retail investors can have when only such a tiny fraction of shares are actually available for public trading.
Definitely. So we've got a company with no revenue, a sky-high speculative valuation, a finance-focused CEO, and this extremely concentrated ownership. It just sounds like a recipe for serious risk. So let's tackle that head on. Chapter 6, risk assessment. If this whole thing were a poker game, these would be the cards you absolutely need to see before you even think about betting the farm.
Okay, let's break it down with a kind of SWOT analysis. Strengths first, though they're limited. You have the CEO, Yat Gayua, showing significant personal commitment. He's put in over $9 million of his own money, and he has that deep personal connection to the treatment. The company does operate in a differentiated niche, applying TCM to neurocognitive disorders. And they do have a clean balance sheet. It's funded almost entirely by equity, very little debt.
Okay, those sound more like personal and maybe foundational strengths, but what about the weaknesses, the inherent flaws that could really trip them up?
Oh, the weaknesses are significant. The biggest one. The company is entirely pre-commercial. No sales, no profits, no approved products, nothing. Its scientific basis is largely unproven, relying mostly on anecdotal evidence, not rigorous clinical data. There's huge key person risk. The whole business seems critically reliant on the CEO and his father for those proprietary formulae. And with only 12 employees, they have very limited operational scale to conduct the complex, expensive clinical trials needed for approval.
Okay, but are there any big upsides, any real opportunities if, against all odds, they somehow manage to beat this and succeed?
Well, theoretically, yes. There is a significant unmet medical need for ADHD and ASD treatments. Many patients and families are looking for alternatives to conventional drugs, and the global TCM market is growing, driven by that increasing interest in natural health solutions. So, if RGC's treatment somehow turned out to be genuinely revolutionary and got approved, the market opportunity could indeed be massive.
But, and this feels like a big but, what are the truly existential dangers, the biggest threats hanging over Regencell that could just wipe out all that potential?
The single greatest threat, without a doubt, is regulatory failure. The probability of failing to get approval from stringent bodies like the FDA is extremely high for any new drug, let alone one based on TCM with limited data. Failure here would likely render their core assets pretty much worthless. They also face that intense competition from well-funded pharma giants. And the current multi-billion-dollar market cap itself is a huge risk. It's completely divorced from fundamentals, creating immense downside potential if or when speculative sentiment fades. Plus, that negative perception from professional investors and the media calling it a speculative bubble that could become a self-fulfilling prophecy.
You know, this feels like a very unique kind of risk compared to, say, a typical biotech company. It's not just about one drug failing in a trial, is it? It feels deeper, more fundamental.
It absolutely is. Most biotech firms face what you might call product risk. A specific drug molecule might fail. But RGC, it faces platform risk. Its entire value proposition is tied to one specific paradigm. The idea that Mr. Aishi's proprietary TCM formulae actually work for these conditions in a way regulators will accept. Western regulatory systems like the FDA, they're built around randomized controlled trials. TCM comes from a different philosophical tradition. So RGC has to not only prove efficacy in a rigorous trial, but do it in a way that satisfies a system that might be inherently skeptical of its whole foundation. Failure in their lead candidate wouldn't just be a setback, it could invalidate the entire premise of the company. That makes the risk far more absolute, more binary, yes or no.
And just quickly zooming out even further, what about the bigger economic picture? Things like interest rates, global tensions. Do they play a role for a company like this?
Well, the direct impact from things like inflation or interest rates is probably limited right now because they're pre-revenue and don't have debt.
Right.
But indirectly, sure, higher interest rates tend to create a risk-off environment in markets. That reduces the appetite for highly speculative, non-earning assets like RGC. Investors get more cautious. And as a Hong Kong-based company operating in the sensitive biotech space, RGC is definitely exposed to significant geopolitical risks stemming from U.S.-China tensions that could potentially lead to things like heightened regulatory scrutiny, maybe getting put on restricted entity lists or other barriers down the road.
Wow. Okay, that's a lot to take in. We've really peeled back the layers on Regencell Bioscience, haven't we? From its, let's say, intriguing business model to its very unique ownership structure and those substantial risks. It's time now to pull all these threads together. Let's offer our final assessment. Time for Chapter 7, Conclusion.
Okay, so our analysis, when you put it all together, it reveals this really stark contrast for Regencell Bioscience. On one hand, you have a compelling narrative, a story. On the other, you have a pretty barren fundamental reality. This company really exists at the absolute extreme end of the investment spectrum. It's a place where market value seems driven almost entirely by speculation, not by any present-day economic substance.
So for anyone out there who might still be looking at RGC and seeing an opportunity, maybe hoping for that massive lottery ticket payoff, what's their argument? What's the bull case, however thin it might be?
Well, the bull case for RGC, if you can call it that, it isn't really an investment thesis in the traditional sense. It's much more of a high-risk, high-reward speculative bet. It rests entirely on that slim, low-probability chance that RGC's TCM formula turns out to be genuinely revolutionary for ADHD and ASD. And if it does and gets approved, then yes, it could tap into a large, growing market. Plus, bulls might point to the founder's conviction, his personal investment, as a strong alignment of interests. And the fact that the company is currently debt-free. That's about it.
Okay, so that's the gamble, the long shot. But let's be crystal clear. What's the overwhelming reality here? What's the dominant bear case that any fundamental investor would see immediately?
No, the bear case is just overwhelming, and it's grounded firmly in fundamental analysis. RGC has no revenue, no profits, no commercial products. It consistently loses money. Its multi-billion-dollar valuation is simply astronomical. It cannot be supported by any rational metric, especially with that price-to-book ratio north of 600x. The underlying science is unproven, relying heavily on anecdote, and it faces exceptionally high regulatory risk, maybe the highest hurdle. The stock's behavior shows all the classic hallmarks of a speculative bubble. Extreme volatility, frequent trading halts, price movements completely disconnected from actual news or fundamentals. And crucially, that complete absence of institutional ownership. That's a massive vote of no confidence from the expert investment community. Plus, the ownership structure itself is dangerously illiquid and overly concentrated.
So, given everything we've discussed, what about that share price, trading around, say, $10 to $15 when all this was happening? What does that price actually represent? Is it justified in any way?
Simply put, no. It is not supported by any credible fundamental valuation methodology. Not even close. Remember our educational DCF exercise. Even with wildly optimistic assumptions, it suggested an intrinsic value probably down in the low single digits per share, maybe $0 and $55 at best. It just dramatically illustrates the enormous disconnect between the market price and any underlying value. There's absolutely no margin of safety at that kind of market price. None.
So what's our ultimate takeaway then? Our final word on Regencell Bioscience as we wrap up this deep dive.
Regencell Bioscience Holdings Limited, RGC. It's just not an investment in the traditional fundamental sense of the word. It's pure speculation. Full stop. The market price reflects the perceived value of, essentially, a lottery ticket. A bet on a potential but highly uncertain medical breakthrough. It does not reflect the present value of any reasonably predictable future cash flows. From a value investing perspective, it's basically the antithesis of a sound investment. The risks, scientific, regulatory, financial, governance-related, they aren't just significant, they're existential. They threaten the very survival of the company as a going concern.
It really is a fascinating case study, though, isn't it? In modern market dynamics. It exposes just how far market psychology can diverge from underlying value sometimes. Definitely seems like a playground for speculators, not for your long-term value-focused investor. So for you, the learner, listening today, this deep dive into Regencell Bioscience, it leaves us with a really provocative thought, I think. In this age of, information overload, constant narratives, powerful stories, how do you distinguish between a compelling story and genuine underlying value? How much does market psychology really influence prices when those fundamental signals are weak, or maybe even completely absent? We really hope this deep dive helped you extract some important nuggets of knowledge today. And if you want to dive even deeper into specific companies or industries, hey, remember to like and subscribe to Stock Analytics AI. For just $4.99 a month, members get priority deep dives on specific tickers. Over the next few months, we're actually planning to cover all of the S&P 500 stocks, and members get exclusive priority access to those. And hey, if you just want a one-off deep dive on a company that really catches your eye, just drop us a super thanks. We appreciate the support.
And please, always remember, this analysis was generated by an AI system. It's intended for educational purposes only. It should absolutely not be considered financial advice. Always, always conduct your own thorough research, or better yet, consult with a qualified financial advisor before making any investment decisions. Critical thinking is just essential in today's world of information overload.
Absolutely. Couldn't agree more. Thank you so much for joining us on the deep dive. We'll be back soon with another fascinating topic to explore.